All right, we're rolling. So we're going to look at leasing a vehicle. Two ways, of course, to finance a vehicle because you don't have the cash to just straight up buy one. Very few people have tens of thousands of dollars laying around in their bank account ready to buy a vehicle. But for those who do, good for them. For the rest of us, the two ways you can finance buying a vehicle are, of course, you can buy and get a loan, which is going to be lesson 9, by the way. Or you can lease. And leasing a vehicle is kind of like you rent the vehicle. It's like renting the vehicle. The difference between paying a mortgage so you can own a property versus paying the rent so that you are paying the person who owns it to let you live there. You are paying the people who own the car to let you drive it. That is the way to think about leasing a vehicle. That doesn't mean that when your lease is up, you can't buy the vehicle if you decide you like it and you want to keep it. In fact, a lot of people end up doing that. But it costs them more money in the long run than buying it in the first place would have. So we'll look at that. Anyway, a couple of definitions for you. Lease term. That's the fixed, non-cancelable period for which a lease agreement is enforced. When you lease a vehicle, you sign a contract, and that contract says, I agree to keep making lease payments on this vehicle for this amount of time. And it's very, very difficult to break a contract like that. You have locked in. The lease payment is the regular payment made to dealerships, typically monthly, and it is, like everything else, taxable. And yes, most provinces have a PST, so it's a two-tax thing when you lease a vehicle. Now, the residual value is the value of the vehicle at the end of the lease. It is also called, are you okay with AKA, also known as? AKA the buyout price. Who decides what the residual value is? Is it like used cars? Do they go look at the Kelley Blue Book? Well, they can't. The Kelley Blue Book doesn't predict in the future how much a car is going to be worth after it's been leased for a couple of years. Kelley Blue Book only deals with vehicles that are already on the road. They are used vehicles. No, the dealership themselves get to decide how much they think the vehicle is going to be worth. And if you disagree with that, then you don't lease from them. But you might, from the sound of that, already get the hint that leasing is kind of not a winning game financially for you. It's a really good thing for the car dealership. And we'll talk about why it's such a great thing for them. And I'm sure I know there are cities, I don't know if there's any in Winnipeg, there are cities that have car dealerships that don't even sell cars. They're nothing but lease only. Because it is a very, very lucrative way to do things. Now, most people don't lease their vehicle. They actually make payments to buy it. But there are some advantages to leasing. We'll get into those in a few minutes. Two more definitions. First, the residual value rate is the rate at which the vehicle holds its value over the term of the lease. And finally, there is the security deposit. Security deposit is a refundable amount that you get back if there aren't any damages to the vehicle when you return it. Again, people who have some experience living in an apartment where you paid rent, you put a security deposit down for your apartment. And if when you move out you haven't done expensive damage that they'd have to pay to repair, then you get your security deposit back. Same thing for a vehicle. And it is calculated by taking the amount approximately of 1 month's lease payments. Usually, when I say approximate, usually, I'll say usually, rounded to the nearest $50. So for example, a 300, that's a funny way to write a 3, isn't it? A $380 monthly payment would have a security deposit of $400. And maybe I'll do one more. What do you think a $330 payment would lead to for a security deposit? Look at what I said, rounded to the nearest 50. So if it's 330, would they just round down to 300? No, they'd round up to 350. Get it? So it's rounded to the nearest 50. That's how security deposits in apartments usually work too. They usually just round to the nearest 50 for whatever the monthly rent is. Okay, so basically a lease payment, you're paying, of course, the car dealership to rent their vehicle. But how do they set the prices for rent? Well, what they have to do, remember, if they're going to sell it once you're done driving it for 2 years or 3 years, remember that those 2 or 3 years are the years where the most depreciation has happened. Remember we did a calculation on one of the assignments the other day where a vehicle lost $27,000 in value over the first 2 years. Well, that's going to happen to a vehicle that's being leased out. So that right there is the majority of what you're paying for when you lease the vehicle. You're paying for the depreciation. And this is why car dealerships love leasing vehicles. If a vehicle just sits on their lot and doesn't get sold, and then eventually, well, it's not a new car after a year, we have to cut down the price, boy, that costs them a lot of money, right? They lose the depreciation. But if they can rent that car out to people as a lease for that first year, they've earned back how much that vehicle depreciated, plus some, because they charge you a little more than it would actually cost in the depreciation of that vehicle. So leasing vehicles is an extremely lucrative thing. That means you can make a lot of money for car dealerships. Now, how are they for you? What are the advantages for you, the consumer? Well, like everything in life, there's advantages and disadvantages. The advantages of leasing is you can, of course, drive a new car every 2 to 4 years, and it's not your problem that you had to buy a new vehicle, it depreciated on you, and then you tried to sell it or trade it in for another vehicle. You don't have to hassle that. You just drive back up and say, okay, my lease is over, give me something else. And again, this is a huge reason why some of the most common types of people, I shouldn't say types of people, the common industry that people work in that will lease vehicles will be industries where people either move around a lot, so they don't want to be tied down to a vehicle, they have to move from one place to the other, or again, kind of like I was talking about my in-laws who are people that, they manage other people's money. Their job is to try to get people to invest their savings with them. It's in their best interest to always drive around in a new looking car. It makes you look successful. So business people who deal with other people's money, very often their thing is they lease the vehicles. That way every couple of years they've got something new because they only lease for a couple of years. Now, there's another advantage to people like that. Something you can do with your lease payments, because you're not paying to own things, you're paying to rent it. And business owners can claim, that's supposed to be a CL, that's not a D. Lease payments as a business. Oh, sorry, my printing's really bad today. Expense for tax reasons. Businesses pay taxes the same way that private citizens do. And if you own the building that your business is in, you own property, you own machinery, all of those things are called assets, and you can be taxed based on how much assets your company has. Well, owning a vehicle is, of course, then an asset. But if you lease the vehicle, it's not an asset. In fact, you can even get some of that money back as a business expense. It's a business expense to have to pay to lease the vehicles. So most businesses would rather lease their vehicles than buy new ones. And again, it might be in their best interest because, go back to the first point, maybe it's good for that business to always look like they're successful and they've got brand new vehicles that their employees are driving around in all the time. Okay? Another advantage is you are never stuck with a vehicle that might be hard to sell. Right? It can be tough to sell a vehicle. We have somebody in the class who is in the market for a vehicle right now, and if you've been at it for a few months, you're going to look at Auto Trader or the newspaper for cars for sale, and you're going to see the same ads over and over and over again. Guys sitting on vehicles that just aren't getting the price that they want for it, so they're kind of stuck with it. That doesn't happen to you when you're leasing because you don't own it, right? Your lease is up, you drive back, you give them the keys and say, thanks, what else you got? So as weird as it might seem to be that, wait a minute, I'm stuck with owning something? Why would I be stuck? Well, if you need to move on to a different vehicle, you have to get rid of the one you have. And that isn't always as easy as you'd think. Okay? Here's another one. Another advantage to leasing is you are not responsible for much, I should say many. What's a better word here, many or much? I'll say much. Much of the maintenance costs that aren't covered by an owner's warranty. Now, we haven't talked much about warranties, but of course, that's one of the advantages of a brand new vehicle. From bumper to bumper, they say, pretty much everything's covered for the first couple of years. Minus things that wear out because you drive them a lot, like the brake pads, like the air filters, the things that every vehicle has to get replaced every few months or every year or two, depending on how much you drive. But when they say bumper to bumper for the first 2 years, there are a few things that if they don't, they could say, well, wait a minute, it's not quite everything. Some places, some warranties will say, well, bumper to bumper, the drivetrain and all the electrical parts. But what about something even as simple as, oh, well, the door hinge is kind of wearing off on us. That might not be something that's covered in your warranty, even if it's like a brand new vehicle and you've only had it for like a year. Certainly if you're a lease person, you don't worry about any of that. You just take it back to the dealership and say, hey, this isn't working properly. You don't have a warranty. It's their vehicle, not yours. They have to worry about fixing it. Again, compare this to renting an apartment versus owning your house, right? If the dishwasher breaks, if the washing machine breaks, if it's part of what you're paying to rent, the person who rents to you has to fix it if it breaks. And the same thing is true for the vehicle. Not everything, even when they say it's a bumper-to-bumper warranty, there are things that are excluded. Sometimes the option things, like, oh, the stereo, I paid extra for a nice stereo, and it's not working. It's like, well, that's not part of the standard equipment that's covered in the warranty. Sorry. If you want, you could go replace the stereo at your own cost. Again, in a leased vehicle, no, that should be covered. That's not your problem to fix things like that. Finally, and this is the big one, so I saved it for last. Usually, it's lower monthly payments than buying the same car, or I should say vehicle, because, car, truck, van, new. That seems counterintuitive. Wait a minute. Why would it be less? Well, actually, when you think about it, logically, you're not paying to own it, right? So it should cost less. Why does it cost as much as it does? Well, because you are basically paying for the depreciation on that vehicle, as well as whatever profit they are trying to make beyond that by lending and renting you the vehicle. So it is usually cheaper. You can drive around in that brand new vehicle for less than if you were buying it. But keep in mind, in a couple of years, you got to take it back. It's not yours. Next, disadvantages. You gain no equity with your payments. Another disadvantage is usually you pay more towards interest. When you buy a car, even if you go through a bank and get a car loan, believe it or not, you're actually not paying as much interest as you are on a lease. Another disadvantage is leasing, of course. You will always be making payments. When my family bought our 2015 RAV4, if we'd have leased it, we'd have paid less every month. But guess what? I own it now. It's paid off. I'm not making a payment on it anymore. That'll never happen when you're leasing. Okay? Here's the final one. Keep in mind, again, I'm going to go back to the analogy of renting an apartment versus saying buying a condominium. If you buy a condominium, condominiums are like apartments, right? They're a building with many people living in it, and you have your space. But if it's a condominium, there might be some rules as to what you can and can't do. Condominium associations exist that might have some rules, but for the most part, it's your space. You own that piece of the building. If you want to paint the walls purple and orange, go for it. They're your walls. You want to put up a picture, so you got to put nails in the wall, go right ahead. You want to mount that large screen TV to the wall, by all means, put up a bracket and stuff. It's your thing, right? When you want to sell the place, you might want to fix all that stuff and paint them colors that more normal people would rather see on their walls and cover over the holes that you made putting up your large screen TV, but that's all your responsibility. You can do what you want. It's your place. But when you're renting the apartment, you might not be able to do any of that stuff, right? Choosing what color the walls are might not be your choice. You might have to actually get permission to mount something on the wall. They might say no, because it's not your place. You're just renting it. And the same is true with a car. Cars that you rent, or vans or trucks, can have restrictions on where and how much you can drive. If you rent a vehicle, or lease a vehicle, which again is the same thing as renting, and you use it because you're a traveling salesperson who puts you have to cover the territory of all of Manitoba, Saskatchewan, and Alberta, I guarantee you, you will be paying a penalty because the contract you signed when you leased said that you could only drive 25,000 kilometers a year, or something like that, or 30,000 kilometers a year. And obviously, as a salesperson driving all over half of Canada, you're going to be way over that, so you're going to have to pay a penalty on that. Now, why would they put something like that in there? Well, because remember, they're going to be trying to resell this vehicle once you're done driving it. If you're rolling up how many kilometers are on the vehicle, it's not worth as much to them anymore. So you're paying for that. When I lived up north in northern Manitoba, we did briefly look into, should we buy our brand new Toyota 4Runner or should we lease one? And we found out that we couldn't lease one. Toyota, at least the dealership we were at, would not lease to somebody who was living in northern Manitoba because so many of the roads are gravel. Driving around on rough gravel dirt roads for 2 years or 3 years is going to decrease the value of that vehicle in their eyes. So they weren't even going to lease it to me. So there were restrictions on where you could drive if you leased a vehicle. So there you go. If you want to lease a truck because you want to use it to pull a great big RV trailer, there might be a restriction on that. You might be in violation of your lease if you do that because that puts more strain on the engine. If you do lots of driving like that, again, it makes that truck less valuable for them when they want to sell it. So that is a disadvantage to leasing. It's not yours. You don't get to do with it whatever the heck you want. All right, that's the notes. Let's do the math. Example 1. The following describes a new SUV in Steinbach, Manitoba. The cost of the vehicle is $34,000 plus taxes. Freight is included in this price. The monthly lease payment is $349 plus taxes for a lease term of 36 months. For leasing, a down payment is required. Yeah, very often you have to put down a down payment when you lease. It's $33,850. Sorry. As well, a refundable security deposit of $500, and for the first month's payment must be made when the lease is signed. The residual value rate is 75% after 3 years. Calculate the total monthly lease payment, including taxes. All right, so it says $349, and including taxes, you pay both taxes, GST, PST, so that's 12%. So that's $390.88. I already punched the buttons on this. Now, calculate the total lease payment. Well, if I pay that every month for 36 months, I make this payment 36 times, which is $14,071.68. Finally, calculate the amount which must be paid at the start of the lease. Okay, so I have to pay the down payment of $38,050, or sorry, $3,850. I keep adding a zero to that number. $3,850 is the down payment right there. Down payments. I have to pay the first month's payment of $349 plus tax. And I'm going to assume that the $3,850 is including taxes. It doesn't say in this question, which is a little bit annoying, but okay. We'll just assume this one has taxes built in. And then, of course, your security deposit, you don't have to put taxes on a security deposit. So there we go. Calculate all that, add all that up. So let's see. That is $3,850 plus $349 times 112% plus $500. And I get $4,740.88. Okay. There's example 1. Example 2. For the vehicle in example 1, the residual value rate is 75% after 3 years. Calculate the residual value for the vehicle after 3 years. So after 3 years, it retains 75% of its value. And then it says including taxes. So if you wanted to buy this vehicle at the end of the lease in 3 years, you'd have to come up with 75% of $34,000 times the taxes. And I've punched this button already. I've got $28,560. So, final part of example 1, 2, and 3 are all the same situation. Final part of the example. At the end of the 3-year lease, you have the option of returning the vehicle or purchasing it for its residual value. Calculate the total price you would pay for the vehicle if you purchased it after the 3-year lease is over. So, the buyout price was $28,560, right? So that's the buyout price. I just calculated that. So that's my buyout price. Then, of course, we calculated from earlier in the question here, we calculated $14,071.68, which was all 36 payments that you made to lease for over the 3 years. And then there was, from the second part here, there was the down payment. Now, careful. Do I want all of this number added? Where did this number come from again? The down payment, 1 month's, the first month's, what you would call the first month's lease payment, and security deposit. Well, hang on a sec. If I calculated 36 payments, wasn't this one of them? And if I brought it back, and assuming I brought it back and it's in good shape, I mean, it must be, I want to buy it, it must be still in good shape, don't I get my security deposit back? So I just have to worry about the down payment. So what was the down payment again? That's how good my memory is. I just scrolled away from that number and I can't see it now. I don't remember. $3,850. So that's my down payment. And please note, assume that you get the security deposit back, and I'll say, and don't count the first payment twice. Right? So that's why I went back to this number, not the number that I had in example 1 part C. Add it up. $28,560 plus $14,071.68 plus 3,850. Remember, the down payment didn't have a tax on it, it was built in. And remember that these payments here already have the taxes built into them. And this buyout price is already including taxes here. So don't put taxes on it again. All these numbers already have their taxes built in. So final answer, $46,481.68. Now, can we go back in time a little bit here to 3 years ago when this car was sitting new on the lot? How much was it worth again? Remember that this car's original price was $34,000. So the fact that I leased it instead of buying it in the first place cost me over $16,000. But it's possible that I didn't know that I wanted to keep it, so, right, hindsight's 20/20. Leasing and then buying at the end of the lease almost always is not a good financial decision. But, depending on your situation, leasing itself can be a better financial decision than buying, because your monthly payments are smaller. If you're buying a new vehicle and you just know, in a couple of years I'm going to get rid of it anyway, you might have been better off leasing. Okay? So there's the examples. Your job now is to do the assignments. It's on the blog. I can stop the video now. Thanks for watching, anybody who was watching.